Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sise, your tutor and your mentor. Today, we are going to continue IFRS 16, Leases. We have covered the previous two lectures. So today, we are going to focus on the subsequent measurement. So after we have completed the initial measurement, now we are going to look at the end of year one. How are we going to present the right of use asset and the lease liability in the financial statement? So this is what we are going to look at. So for subsequent measurement, now for the initial measurement, we need to know when there is a lease transaction, the double entry, we need to debit right of use asset and we credit the lease liability. So this is the accounting treatment for the lessee, right? So now, after we have calculated the lease liability, which is the present value of the future payment, so we are going to debit the rights of use asset and we are going to credit the lease liability. For the right of use assets, we have another component that we are going to add to ensure that we get the total value that we are going to show as the right of use assets. So now, after we have completed initial recognition, we need to do subsequent measurement. We need to value the right of use assets at the end of the year. What will be the right of use assets after we have calculated our depreciation? Also, what will be the closing balance of the liability after we have calculated the interest and we have deducted the payment that is made by the lessee? So now let's start with the right of use asset. Very important. Now, we can either carry and measure the right of use asset using the cost model. It means the value of the right of use assets less the accumulated depreciation or impairment loss. So now we are going to look at how we can depreciate the right of use assets, key concept that you need to know for the examination. How are we going to depreciate the right of use assets? Now, first rule, if the ownership of the asset is transferred to the lessee, if at the end of the lease term, the lease asset will be transferred to the lessee, then it means we need to depreciate the asset over the useful life of the asset. You need to note this point down. If the asset will be transferred to the lessee, if the asset will be transferred to the lessee at the end of the useful life of, or at the end of the lease term, then it means we need to depreciate the assets over the useful life of the assets, not the lease term. It's clear. Second condition, if the ownership is not transferred to the lessee, then it means we are going to depreciate the right of use assets, either the lower of the lease term or the useful life of the asset. Which one is lower? That's what we are going to use. So now, for example, a motor vehicle with a useful life of 3 years. The lessor lease the motor vehicle to the lessee with for a period of 2 years, for example. Now, at the end of the lease period, the motor vehicle will be returned back to the lessor. So in this particular situation, we are going to use the lower of the right of use assets or the lease term. So in this situation, we are going to use the 2 years to calculate our depreciation. So that's exactly what we are going to do to calculate our depreciation. So in a situation where the right of use assets is where the lease term is greater than the right of use asset, then it means we are going to depreciate the asset using the lease term. If the lease term is less than the useful life of the asset, then we are going to depreciate the asset using the lease term. We are going to use the shorter of the useful life and the lease term. If ownership of the asset is not transferred to the lessee, if at the end of the lease term, the lessee who has the right to use the asset will return back the asset to the lessor, then it means ownership is not transferred. So in that situation, we are going to depreciate the right of use asset using the lower of the useful life and the lease term. Very simple. Very simple. Now, for the rights of use assets, that's all what you need to know for the examination for subsequent measurement. Now we are looking at the liability, which is the more technical and little bit critical to understand. So now when we are talking about the liability, the carrying amount of the lease liability is increased by the interest charge. First point that you need to know. First important point that you need to know for the examination. The lease liability, the lease liability will be increased by the interest charge. Why are we going to increase the lease liability by the interest charge? This is because components of the lease liability calculation contain the present value of the future lease liability payment. So in that situation, we have discounted the future payment to its present value. So for us to reflect the future value, we need to increase the liability year on year. So that's why we are going to ensure that on annual basis, we are going to charge an interest that will increase the liability. First important point. Another relevant point you need to know with regard to the calculation of the outstanding liability. The outstanding liability multiplied by the discount rate of interest. That's what we are going to do. This interest is also recorded in the statement of profit or loss. Now, this is the double thing. When we are going to calculate the interest, we are going to debit expenses and we are going to credit the lease liability. We are going to increase the liability and we are going to reduce the expenses. We are going to debit expenses. Very good. Second point that we need to know for the liability, the carrying amount of the lease liability is reduced by the cash repayment. For example, the cash payment that the lessee will make to the lessor, we are going to reduce the lease liability by that particular amount. So we are going to debit the lease liability and we are going to credit cash because of this is cash payment. So you need to know these two double entry because we are going to use these two double entry throughout the session of the subsequent measurement for the liability. Also, when we are going to look at IFRS 9, you need to know this double entry because when we are going to look at the amortized cost, because this is the method that we are going to use. Very good. Now, to work out the interest and the year-end liability, to work out the interest and the year-end liability, a lease liability table is often used. That this is the table that we are going to use to calculate the interest and the closing liability because the interest will be shown in the statement of profit and loss and the closing liability will be shown in the statement of financial position. Also, we are going to look at how we can split between the total liability, we can split it between the current and the non-current liability throughout the session. So now, we are going to determine the payment, we are going to determine the approach that we are going to use based on the cash payment that the lessee will make. If the payment will be made in arrears, in other words, at the end of the year. For example, if the lease agreement is on the 1st January 20x1, now, if the lessee is going to make payment at the end of the year, let me underline it. If the lessee is going to make payment at the end of the year, it means that payment is in arrears. So if that is the case, we are going to use this approach to calculate our interest and our closing liability. So this is the approach that we are going to use. If the payment will be made at the end of the year, not at the start. Very clear. So now we are going to look at the year. This is the table, the lease liability table. We are going to look at the balance brought forward. This is the amount that we are going to debit as the lease liability. So now we are going to place it for year one. Then automatically we are going to calculate interest. We are going to increase the interest. Why are we going to calculate interest before the payment? It is because that the payment will be made at the end of the year. And also the interest should increase the liability before the payment is made. Because why? The payment is made in arrears. Alternatively, if the payment is made in advance, then it means we need to offset the payment before charging the interest. So this is the distinction between payment made in arrears and payment that is made in advance. For payment made in arrears, we need to increase the liability before we are going to deduct the cash payment. We need to increase the liability before we are going to deduct the cash payment. Let me type it so we can able to understand. We need to increase the liability before the cash payment. For in arrears, need to increase the liability by the interest charge before deducting the cash payment made by the lessee. So basically, this is the concept. When payment is made in arrears, this is what you need to know. Now, what about if payment is made in advance? What are we going to do? When payment is made in advance, before we are going to increase the liability, we need to deduct the cash payment made by the lessee before we are going to increase the liability, before we are going to calculate the interest charge. So now, for payment made in advance, we need to deduct the cash payment made by the lessee before increase the liability by charging by the interest charge. Very simple principle and concept that you need to know. Understanding this analysis will help you to understand what are you going to calculate in the examination. So this is the simple approach. So now if we look at the lease liability table for payments made in advance, the balance brought forward, we are going to less the payment, the cash payment, we are going to less it. Then this will give us a subtotal. So we are going to calculate interest based on this subtotal. Then it will give us the carrying forward, the balance at the end of year one and the balance at the end of year two. Then the net will be the non-current liability. Simple. Another important concept that you need to know for the examination, because according to IES 1, the presentation of the financial statement, it is required us to present certain information in a distinct manner. For example, if we have a total liability of this, for example, we need to split between the total liability, what is current, that which can be settled within 12 months, and what is non-current, that cannot be settled for the next 12 months. Very simple. So we need to split the liability into two, current and non-current. So we need to know when payment is made in arrears, how are we going to split the liability? And when payment is made in advance, how are we going to split the liability between current and non-current? So this is what we are going to cover in this section. On the statement of financial position, the total liability on the statement of financial position, the total liability at the end of year one is split between the non-current and the current. For payments made in advance or in arrears, the non-current liability is represented by the balance outstanding immediately after the payment if year two. So we are looking at the balance after the payment. That's what the key aspect that we need to know. The balance after the cash payment, that's what the point that we are going to use to calculate the distinction between, to split between the current and the non-current after the payment in year two. Why are we going to use year two? Because at year one, we can't able to split the next between the non-current and the current liability. But at year two, we are going to calculate the closing liability at year two, which means that this is the liability that we're supposed to pay in the next 2 years. So subtract it from year one will give us the current um, liability, and the year two will be the non-current liability. But we are going to look at it when we are going to solve. Now, the difference between the total liability at the end, at the year end, and the non-current liability will be the current liability. Note that where payments are made in advance, the non-current liability is not the balance outstanding at the year end of year two. Why? Because it contains the element of interest charge. So we are going to use the subtotal to factor, to calculate, to split between the current liability and the non-current liability when payment is done in advance. Very simple, and it's crystal clear. So now we are going to look at this illustration to explain, to analyze the figures based on what I have explained. Now, illustration 2. The requirement stated what figures will be shown in the financial statement for the year ended 31st December 20x2, 31st December. R enters into an agreement to lease an asset. The terms of the lease are as follows. Primary period is 4 years from 1st January 20x2 with a rental of $2,000 per annum payable on 31st December 20, on 31st December each year. So now the question is telling us that the lease period is 2 years starting from 1st January 20x2 with an annual rent. The cash payment is 2,000 payable at the end of each year. So it means this question is referring to payments made in arrears. So when we are going to calculate our interest and our closing liability, we are going to use the lease liability table for payments made in arrears. Second, the present value of the lease payment is 5710. In this question, the present value is given to us, which is very simple. So we don't need to calculate it from sorry, the various analysis I've done in the previous lecture. Sorry. Third, the interest rate implicit in the lease is 15%. So we are going to use the 15% to calculate our interest charge. So basically, this is the question. The requirement stated for us to calculate, for us to show the double entry for the first year, 31st December 2021. Now, I'm just going to explain the solution because I'm currently having challenges with regards to the scratch pad I'm using. So I'm not going to, it will be difficult for me to solve because of the scratch pad. It's not, it has some little bits of challenges. So now, a non-current, a non-current right of use asset is recorded. Now, we are going to do the analysis. We are going to debit the right of use asset and we are going to credit the lease liability for initial recognition. Let me add something. Initial initial recognition equals to debit the right of use asset and credit the lease liability. With what amount? With 5710 with 5710 because this is the present value of the lease payment. So now what are we going to do next? For the right of use asset, for subsequent measurements at the end of December, this is at the first January 20x2, the initial recognition. At 31st December 20x2, the right of use asset will equals to 5710, and the depreciation the depreciation will equals to the right of use asset divided by, it depends. Now from the question, the question is not clearly mentioned about whether the the control is transferred or not, but automatically in the question, the only period that is given is the lease period, the lease term. The useful life of the asset is not given, so we are going to depreciate using the lease term of 4 years lease term. So now 5710 divided by 4 will give us the depreciation, which is 1428. Look at it. Very good. Look at it, 1428. So this is the depreciation. So now, so the difference between the depreciation and the right of use asset will be the value of the right of use asset at the end of December 20x2. So now the right of use asset value at 31st December 20x2 equals to 5710 minus 1427.5. So basically, this will be the value at the 31st of December 20x2. So we have completed the treatment for the right of use asset. So now we are going to look at the lease liability. Very simple. Now at year one, we are going to prepare the lease liability table for payment made in arrears. And again, it's very simple. For year one, we are going to take the lease liability, which is 5710, the initial recognition amount. So now we are going to add the interest. We are going to calculate 50% of the balance brought forward because the payment is made in arrears. So we need to increase the liability before we are going to deduct the payment. So this is the concept. Very simple. So now 15% of 5710 will give us 857, and we are going to subtract 2000, the cash payment that is made by the lessee to the lessor. So the closing liability will be 4567 for year one. And year two, the opening liability will be 4567. The closing liability of year one will be the opening liability of year two, which is very simple and common to understand. Now we need to calculate 15% of the opening liability for year two, and we are going to increase the liability by this 15%. Also, we are going to deduct the cash payment. Then the difference will be the closing liability, 3252. And that's how we are going to do for the rest of the remaining years. Very simple. So now the total interest payment is 2290 and the total cash payment is 8000. So now we need to split between the current liability and the non-current liability. It is very simple. This is the total liability for year one, and this is the remaining liability for year two. So it means At year one, the liability is 4567. The obligation is 4567. At year two, the obligation is 3252. So it means the difference between the 4567 and the 3252 is what we refer to as the current liability. That if we want to split between the current and non-current liability, the difference between year one and year two will be the current liability. So that's how we are going to identify the current liability from the non-current liability. So basically, this is the calculation I've calculated. Then we are just going to do for year one. The depreciation is 1428. The interest payment is 857 from year one calculation. Um, Now the statement of financial position, the right of use assets minus the depreciation will give us 4282. The lease liability, the non-current is 3525 and the current is 1351. But the total liability is 4567 because in year one, the total liability is 4567. We tried to split it because of presentation and according to IES 1. So basically, this is what you need to understand for the lease liability and the rights of use asset for subsequent measurement. So if you're going to do this extract of statement of financial position for year two, then automatically we need to deduct the depreciation from this remaining value. We need to deduct the depreciation. Then also we need to put the interest for year two. Now let me do for year two. Oh, sorry. So year two, right? So the depreciation will be the same, 41428, and the interest will not be the same. The interest, look at it from 685 from the lease liability table, 685, 685, and for year two, the total liability is 3252, but the year three liability is 1740. So the difference between year two and year three will be the current liability. So it's simple. So the right of use asset will be for year two will be 4282 minus the depreciation minus depreciation. So this will give us 4282 minus depreciation. Just a minute, let me use my calculator. 4282 minus depreciation of 1428. So it will give us 2854 for year two. Then we are going to split the liability between current and non-current. So now we are going to take the year three liability, which is 1740. That will be the non-current liability. 1740, 1740. And the difference between the year two liability of 3252, 3252 minus 1740 will be the non-current liability. The current, sorry, 3252 minus 1740 will give us 1512. So basically, this is the entry that we're going to do for year two and for year three and so forth. So basically, this is what you need to know for the examination. So now we are going to look at the short life and the low value asset. According to IFRS 16, most leased transaction, most leases should be recognized using the rights of use asset and the lease liability, with except to short life and low value asset. You can go back to my lecture one, then you can able to understand why we are not going to include the short life asset and the low value asset as the rights of use asset and the lease liability. Instead, we are going to spread it out through the on a straight line basis in the statement of profit or loss, instead of recognizing an asset and a liability. We are not going to recognize assets and we are not going to recognize liability. Instead, we are going to spread it on a straight line basis in the statement of profit or loss. Now we are going to look at the condition for short life and a low value asset. If the lease is short term, 12 months or less at the inception date, or of low value, then simplified treatment is allowed. That's the condition. In this case, the lessee can choose to recognize the lease payment in the profit or loss on a straight line basis. No lease liability, no lease liability, no lease liability. This is the important point. No lease liability or right of use assets will therefore be recognized. We are not going to recognize the lease liability or the right of use asset for short life or low value assets. Very important point to note. IFRS 16, leases does not specify a particular monetary amount below which an asset will be considered low value, although the basis for conclusion indicates a value of $5,000 as a guide. That's just a guide. But by default, there are certain items mentioned according to IFRS 16 that is classified as low value: tablets, small personal computers, telephones, small items of furniture. So now, let's look at the low value example. Very simple. Let's look at the low value example so we can able to understand. Um, Show the impact of this lease arrangement on the financial statement of this. On 1st of T for the year ended 31st December 2006. On 1st April 2006, T acquired telephone for its sales force under a 2-year lease agreement. The terms of the lease require an initial payment of 2,000, initial payment, followed by a two payment of 8,000 each on 31st March 2007, 31st March. So from April 2006 to March is 1 year and another 1 year, which is 2 year, 2008. But now the question required us to prepare financial statement as at 31st December 2006 in 9 months, from April to December is 9 months. But let's calculate the annual expense. We are going to use on straight line cash payment for the whole period divided by the number of years. So it will be 2,000. It equals to total payment divided by the lease term, which will equals to 2,000 plus 8,000 plus 8,000 divided by 2. So basically the answer is 9,000. Very clear. So now what we are going to do, we need to look at the expense that we are going to show as at the 31st of December 2006. Expense as at 31st December 2006 will equals to 9 divided by 12 multiply by 9,000 will give us 6,750. This is the expense. But now let's understand something, right? At the inception, it required an initial payment of 2,000. Initial payment of 2,000. So if the initial payment is 2,000, then the expense amount is 6,750. So it means we need to accrue for the difference. We need to show the difference as a liability. so that the account will balance. So now we need to accrue at 31st December 20x6, which will equals to 6750 minus 6750 minus 2000. So we are going to accrue for 4750. But what you need to know from this section is how you can calculate the annual expense. This is what you need to know, how to calculate the annual expense. Very important. So basically, for any, sorry, for any low value asset or a short life asset, this is how we are going to treat it under the lease agreement. We are not going to recognize the rights of use asset and the lease liability. So finally, we are going to look at the mid-year entering into a lease. For example, our financial period is from the 1st January 20x2 to the 31st of December. So now, if the lessee entered into a contract on let's say 1st June, so now it means the lessee will need to account for a 6-month lease transaction in the financial statement. 6 months right of use assets, 6 months lease liability, 6 months liability. What I'm saying is that we need, for example, if we are going to calculate the depreciation, we need to ensure that the depreciation we are going to calculate, we are going to prorate it. Also, we are going to prorate the interest. So don't forget these two elements. We are going to prorate the depreciation and we are going to prorate the interest based on the period that we are going to prepare the financial statements. If a company enters into a lease partway through the year, the depreciation and interest will need to be time apportioned. The liability table is likely to need extra column to split the table between pre and post. Nothing to worry about it. You just need to calculate your liability, your depreciation and prorate it, calculate your interest and prorate it. Simple. So basically for this session today, this is what we are going to cover. In our next session, we are going to look at the sales and lease back transaction. This will be the final session, the sales and lease back. Then we are going to complete IFRS 16. So thank you very much for your time.